This week on WealthTrack, why everything is not what it seems. First Eagle's Matt McLennan believes the market's return to normalcy is a mirage, requiring extra care and caution for investors. He tells us where he is finding investment oases next on Consuelo Mack WealthTrack.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Luma Sales, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. And Rosalind P. Walter. Hello and welcome to this edition of WealthTrack. I'm Consuelo Mack. 5 years after the collapse of Lehman Brothers in 2008, how confident do you feel about the stability of the global financial system? Do you believe that the problems that caused the financial crisis have been solved? Are we in danger of another one? Well, Hank Paulson, the Treasury Secretary during the crisis, recently answered that question in the affirmative. At a speech at the Economic Club of New York, he said, "The answer, I'm afraid, is yes. As long as there have been financial markets and humans who periodically experience bouts of panic, there have been financial crises. In recent history, we've tended to have crises every 8 years or so. Historically, they've been manageable. The key is to avoid massive disruptions like 2008 or like the Great Depression." Well, amen to that. But are we in a better position to avoid massive disruptions like we experienced in 2008 and 2009? Investors in the U.S. seem to think so. The blue chip Dow Jones Industrial Average has more than doubled since its March 2009 low, and financial stocks have been among the biggest winners. The 1990s phrase Goldilocks economy is being heard in some quarters again as the economy recovers with little evidence of inflation. Central bankers remain on alert around the world, ready to withdraw stimulus in the case of the Federal Reserve, continuing to provide it in the case of the European Central Bank. However, as former Treasury Secretary Paulson went on to say in his speech, there are a number of issues that trouble and in some cases flabbergast me. He cited the lack of reforms at Fannie Mae and Freddie Mac, the government-controlled mortgage agencies that underwrite 90% of the nation's mortgages. The unregulated shadow banking system, which is still not fixed and was a source of so much trouble back then, and the too-big-to-fail banks yet to be resolved. Today's WealthTrack guest has his own list of what he calls financial fault lines, trouble spots that he believes have the potential to shake up economies and markets. He is Matthew McLennan, head of global value and a portfolio manager at First Eagle Investment Management. He is best known for taking over the reins of the First Eagle Global Fund from legendary great investor Jean Marie Eveillard 5 years ago as the financial crisis unfolded. The fund is still rated 5-star by Morningstar for its outstanding track record and ability to preserve capital. I asked McLennan why he calls the recovery in the U.S. economy and markets a Keynesian mirage.
When you're a value investor, you start with the balance sheet and the free cash flow statement when you're looking at a company because it gives you big hints as to what might be going on with market position or management character. We started to notice over the last decade and a half balance sheet issues around the world, malinvestment in countries with current account surpluses, a lot of white elephant project spending, and recurrent credit crises in current account deficit countries, be they emerging markets or the United States. And we start to ask questions then about what's wrong with the structural shape of the financial architecture in the world that produces this. And we had it culminate in a crisis in 2008, but the market never really cleared fully. We had a crisis, but we had unprecedented state intervention, both fiscal easing and monetary easing, that supported demand at a time when corporations were hunkering down. The reason I say Keynesian mirage is that stability of demand that was produced by unprecedented state intervention happened at a time of corporate prudence. So corporate margins have gone up a lot.
Profit margins.
Profit margins.
Right.
Business sentiment has improved quite a lot. there's this feeling that we're back to normal. Spreads have come from 1,000 over in the high yield universe down to 400 over.
Right, these are yield spreads, right?
Yeah, absolutely. Measures of risk perception such as implied volatility have come from 40% down to 14 or 15% in the equity markets. The equity markets doubled off the bottom. It feels like we're getting back to normal, but we never actually had a full economic adjustment. Instead, we've obfuscated and amortized the problems. You can't defy gravity.
Wouldn't it have just been a complete disaster had the markets fully cleared? I mean, is it possible to have stability with the kind of intervention that we've had by central banks?
It actually would have been a disaster, but then we would have recovered from the ashes with a clean slate. A lot of debt would have been written off. Instead, the debt has been transferred from the private sector to the government's balance sheet. And so we're at this point in time where we have a generationally low level of aggregate savings in the United States, yet we have generationally high corporate profit margins. Those two things shouldn't coexist over the long term. So we run the risk now that we start to unwind that monetary ease, now that we start to unwind the fiscal ease, and now that corporations are no longer in hunker down mode, that corporate profit margins come into question at some point in time.
You use the phrase financial fault lines, and that you're tracking around the globe, but how dangerous is this current, state that we're in, even with the recovery? How concerned are you, and where do you see the most vulnerabilities looking around the world?
Well, we do worry about the sensitivity of the US economy to this backup in long-term interest rates, to higher oil prices. The fact is, with 3% household savings rates, there's not a lot of resilience against those kind of external pressures. And of course, that could have a negative effect on corporate profit margins. Outside of our borders, we worry in Europe that while the periphery may have adjusted through having a depression-like problem in their labor markets and therefore lower labor costs.
So you're talking about the weaker Spain, Portugal,
exactly.
Italy.
Those countries have recovered somewhat, but to an unstable political position. But countries like France have not adjusted. Their labor costs now stand out like a sore thumb in the context of Europe. If we have an adjustment issue in France, that's a core issue in Europe. It's not a peripheral issue. And if we go to Asia, we've spoken a lot about the transition risk in the Chinese economy from what was an epic investment boom.
Right.
Okay.
Where they were investing in infrastructure and real estate and.
But beyond all measure of reasonableness relative to historic measures. And we always worry about the combined effects of investment and credit booms. And China was at the epicenter of global monetary creation and investment in fixed capital infrastructure. Now, that transition to a less investment-led economy is happening at a time where their competitiveness is being undermined by currency debasement outside of China. You've seen in the last handful of months, Japan, India, Indonesia all have their currencies weakened by 20%. The Thai baht, the Malaysian ringgit, all off 10%. So the Chinese currency, which has remained firm versus the US dollar, is now exposed versus its neighbors. And so this, to us, presents a little bit of instability in the Asian region. And don't forget, back in 2009, US investors underestimated how important Chinese stimulus would be to the global recovery. If there's an issue in China, US investors may underestimate how sensitive the price of risk is globally to that event. And so those are some of the things that we're a little bit worried about. And we didn't even speak about the Middle East.
How does the Middle East figure in?
It's an unknowable. It's an incredibly complicated geopolitical realm. Rather like the Balkans, in 1913, it's a region of the world that brings all interests together in one focal point. So we do believe it's an important area to keep a focus on, but we also believe it's fundamentally difficult to predict. At First Eagle, we've always had the belief that our crystal ball is foggy at best, that we can't predict the future with certainty. When we look at all of these macro factors, the key point is that we think it's a time for some degree of caution, not complacency. And markets are priced for a degree of complacency.
So looking back over the last 5 years since the beginning of the financial crisis, a relative of mine was recently in the hospital, and I said, well, how do you feel, from 0 to 10, with 10 being the worst pain and 0 being the least, where are you? So as far as, your concern about the fragility of the financial system or the fact that markets are not recognizing these issues that you see. So where are you in a scale of 0 to 10?
In a scale of 0 to 10, certainly above 5.
And this is a pain threshold.
It's a pain threshold,
right?
and I'm told that I have a high pain threshold, so a score above 5 might be a bad score. But what I will say is that some of the imbalances have corrected from their levels of 2007, 2008. But They have not fully corrected. Meanwhile, we have an accumulated stock of problems, notably the sovereign debt in the developed countries of the world.
Right. So this is the government debt that you're talking about, and that's a huge problem. Because, I mean, what kind of a problem do you see with the
it's
government debt?
It's a problem because as an investor,
world?
it makes you realize it could be quite some time before you get an attractive real return on human-made money.
Right.
You know, at First Eagle, our goal has always been to produce superior real returns and to have an element of resilience in time of crisis. Now, that goal is even more relevant in a time where you have repressed real returns and a vulnerable financial architecture. And that's really the way we're looking at it.
Right. So you know, to translate that into in portfolio strategy, you have around 20% cash position in the First Eagle Global Fund. And so, you know, again, in that pain threshold scheme of things, so 20% is high for you?
It's certainly higher than where we were. For example, in March of 2009, we had some of our lowest cash positions.
Right.
Because ultimately, we believe in order to produce superior real returns, you have to be a buyer of businesses one at a time with a margin of safe cash. That 20% is sort of at the higher end of where we've been for the last handful of years. There were windows in the late 90s where we had higher cash than that, but it would be consistent with an above 5 reading on the stress meter here.
Right. But the other 80% is invested of the portfolio.
Correct.
And so, you know, tell us essentially, you know, where you're invested. What is your strategy right now? And I'll start out by saying that gold and gold stocks have always been a part of the portfolio.
Well, when we look at the overall portfolio, 70% of the portfolio is invested in equities. So, and when we talk about 20% cash, it's not a macro call. We're not there saying, well, we think markets have this multiple and therefore we should have this amount of cash. It's a residual of a disciplined approach to buying businesses one at a time.
Right.
And it just shouldn't be a surprise in an uncertain macro environment when prices have gone up. We're not finding as many margin of safety opportunities. We've talked about equities being the least worst choice over the last handful of years.
You still feel that way?
Probably, but it's becoming a tougher choice. And so we are in an environment where, you know, we have pretty low return expectations for most asset classes at this point in time. The gold, on the other hand, is an investment that we have as essentially a monetary reserve, a potential hedge against any breakdown in the financial architecture.
Right.
Now, gold has been a tough place to be.
It certainly has.
And in fact, you know, since 2011, gold has lost half of its value relative to the S&P 500, and the gold stocks have lost a decade of price return. Now,
so how do you deal with that?
Well, we deal with it the way we deal with anything. We take a long-term perspective and hopefully with a dose of equanimity. We own the gold as a hedge against a potential breakdown in the human-made system. The reason we believe that gold has lost value relative to risk assets is simply people have become more confident. But if you believe that now is not a time for complacency, the role of gold in a long-term portfolio is more important than ever. And if you look at the fact that gold has retraced 2 to 3 years of price action, but the miners have retraced a decade of price action, it's probably not a bad time to own some of that gold through the miners. You can get that gold more cheaply in the dirt than you can have it in the physical bullion.
And so are they basically equivalents? I mean, do you look at the gold miners as basically an equivalent portfolio protection to gold itself?
Well, there's an equity risk component to any gold mining investment because management might not do the right thing with your capital. You could have old and depleting assets that have declining ore grades and increasing costs. There's any number of things that could go wrong. But if you have a diversified portfolio of investment in gold miners, you can get a sense for what you're paying for that gold. Okay, and if there's enough of a margin of safety, if it's cheap, if it's enough cheaper to buy the gold via the equities, then you're being compensated for that risk. And if you're diversified, you're taking some of that individual company risk out. So it include companies like Goldcorp, for example, which is a leading low-cost gold producer. It has a footprint predominantly in the Americas. While a lot of gold companies are going to be shrinking because of cutbacks in their capital spending, this is a company that has a new mine coming on in the Dominican Republic. It has sound management, we believe, and you're paying a fair multiple on depressed gold prices. You know, gold prices that are down half relative to the S&P in 2011. Another example would be Fresnillo, the world's leading silver producer. Again, lowest cost major silver producer in the world, Mexican-based assets, net cash on the balance sheet, and a family that's involved, the Bayeris family. We love investing alongside family and founders. It's been a long-term holding for us. And if we can buy high-quality assets in jurisdictions that we think have manageable risks, at modest multiples of what we believe is their intrinsic value, and we get a hedge element for free, if you will.
Right.
To us, that's valuable from a portfolio standpoint.
So, Matt, you were early in Japan, and I'm just wondering where you stand now. I know you buy individual companies, you don't buy countries per se, but you ended up having a fairly substantial amount of your portfolio in Japanese-based companies. So what has happened after the run-up we've had this year?
Well, you're absolutely right about that. After a 2-decade bear market, we had the opportunity to find really good businesses at discounted prices. We were paying single-digit EBIT multiples for franchise businesses that had dominant market share in robotics, dominant market share in bicycle components, dominant share in household and business alarms. Instant noodles. So you look across our portfolio of Japanese holdings, these were businesses we'd bought one at a time after a 20-year bear market. Now the market has rallied on the hopes for a reflationary set of policies that will hopefully get Japan out of its deflationary funk that it's been in for the past couple of decades. Just like we didn't buy Japan for a macro reason, we're not getting enthusiastic about it for a macro reason. And so we've actually been a net seller of some of our Japanese equity positions, not because we think the market is necessarily overvalued, but some of the great businesses we've bought have gone to intrinsic value. We've had to become much more selective in Japan about the kind of businesses we buy. There has to be something that has gone wrong at the business level that affords us an opportunity to pick up a pearl at a decent price.
So, Matt, one of your investments in prior interviews was Fanuc.
Yes.
Which is a Japanese company. What's your view of Fanuc right now?
Well, Fanuc is the leading producer of CNC machines. These are essentially the controllers for factory automation equipment. They control robots, they control other metal cutting presses and lathes. They have about 60% share of this market globally. And what's happening around the world is, as digitalization happened in the office space with your PC and everything, digitalization is spreading to the factory floor. We're seeing robotic penetration increase long-term at a very important pace. And Fanuc, being the world leader in this industry, I think is very well positioned for that secular trend. We were a buyer of this business during the crisis back in 2008, 2009. The business has obviously reached a higher valuation today than it was back then, but we still believe the business not to be overvalued. We think the company have been good stewards of value for shareholders, not necessarily in the traditional sense of paying huge dividends, although they do have a 30% payout ratio, but that they've run their business for the long term. They talk about walking the narrow path at Fanuc, which means making the right long-term decisions, keeping a tight cost structure, keeping ahead of the curve on innovation. Nearly 40% of their staff are engineers. So if you control 60% of a market, you devote 40% of your energy to engineering, and you have upwards of a 2-decade lead in some technologies such as optical recognition, I think your position for the long term is quite good. And so Fanuc is a long-term holding for us, unless of course it gets to a very full valuation.
Right. So where else are you finding value? What are some of the companies that you bought that you think that represent a discount from their intrinsic value right now? So
to give you an example, in Japan, in this window where everything got re-rated up, there was one security last year that was really out of favor, and that is Hoya. It's a company you've probably never heard about. 10 billion of market cap. It's a world leader in optical technology. Now they have diverse end markets, everything from being a great player in the eyeglass lens business all the way through to contact lenses and endoscopes in the healthcare side. And in technology, they are a dominant producer of polished glass blanks for photomasks, LCDs, hard disk drives. It's a niche business, and they have a great philosophy that's very much First Eagle. We often talk about looking for eclectic royalties. Their CEO, Hiroshi Suzuki, talks about the need to be a big fish in a small pond. That's music to our ears at First Eagle. They also talk about the fact that profit comes first at Hoya, rather like Fanuc, which we talked about earlier on. Hoya went through its troubles. There was a period in the last couple of years where they had flooding in Thailand that affected their eyeglass factory. There was disruption to their business in the wake of Fukushima. There were a few things that happened. We were able to buy into this business at an attractive multiple. We think it's still an undervalued security, although it's gone up in price from where we initiated our position, but it's got margins that could improve from current levels. It's got a multiple that's conservative relative to its history, a 3% dividend yield, and a management that has value values that resonate with us.
It sounds like a perfect First Eagle kind of company.
Yeah,
right.
It's quirky, it's eclectic. We have a portfolio of these kind of businesses, and that's really what we look for.
Well, one of your holdings that you and I have talked about in the past that's not quirky, and maybe it's a little bit eclectic, is Microsoft.
Yes.
So what is your position on Microsoft, especially since we now know that Steve Ballmer has announced that he's going to retire? They don't have a new CEO yet. So what's your take on the Microsoft story now?
It may not be quirky or it may not be as eclectic, but it does share common threads. For example, we love the presence of family or founders. Bill Gates is still a chairman, and
right.
I don't think anyone should underestimate the drive of Bill Gates. In fact, there was a great book written about him in the early 90s called Hard Drive. Secondly, it's mischaracterized. I think Microsoft has gone through its own Pepsi challenge equivalent, and that was a great time to buy Coke, by the way, back in the 1980s. Microsoft is seen as this failed consumer software company, but the consumer software business is the 20%, not the 80% of their business. Ultimately, Microsoft is a corporate royalty. They dominate the corporate operating system market, the office software market. They also, around that, do the emails, the SQL servers. They're the dominant server operating software company in the world. And a lot of this business is recurring in nature. Some of it contractually recurring, some of it because the IT departments of the world have been built around servicing Microsoft software. So we think the business is more resilient than people think it is. You're paying 7 times EBIT for Microsoft, which is a valuation consistent with market thinking the business is going to shrink. Yet you're getting a 3% cash flow. They've nearly tripled their EBIT over the last decade, and they're buying back stock. And so we think, whilst it's not a perfect stock, no stock is perfect, it has its issues, every business has its price, and we find it an attractive long-term investment here. So
the one investment for a long-term diversified portfolio would be?
Well, I think either one of the ones we've mentioned is a great long-term investment, and I think that alongside of that, having a little gold in reserve at these prices probably makes sense. And if you're a little bolder, maybe a gold miner.
So I have one more question about gold. So when gold was declining in price, as it was so dramatically, what did you do at First Eagle? Did you reduce your holdings or just let them be reduced for you? I mean, how did you handle that?
That's a good question. I mean, we've typically had a fairly steady allocation to gold bullion and gold equities on a combined basis. Exactly.
Right.
So it's almost like our Tier 1 capital, okay? It's our monetary reserve, and it's really there for the very rainy day. As the gold price came down, what we did is instead of buying the bullion, we actually were buying gold miners. We've felt that as they've sold off dramatically, if the gold bullion lost half of its value versus the S&P 500, the gold miners have lost roughly 3/4 of their value.
Right.
So if you're able to buy something at a level where it was trading a decade ago, when the underlying commodity was far cheaper, if you're able to buy a security that's trading at a price equivalent to its 2008 lows, to us, there's a margin of safety in the price there, in addition to the hedge element of the underlying commodity. And so you've seen our portfolio ownership of gold skew towards the equities. We haven't been a seller of the bullion, but we've been a buyer of the equities instead of the bullion at the margin here.
So I'm just going to follow up on that. Is that's what I didn't understand. So you were holding a position of gold before the big sell-off in bullion,
and a small position in equities.
Right. But you didn't sell the position that you had in gold. You didn't say, we recognize there's a macro trend that's occurring. This is really not the time. You always hold on to a core position of gold?
We do have it. We back in 2011, we trimmed a little bit of gold because it had gone a long way in a short period of time, and our hedge became outsized. And we never want it to be a directional view on gold in our portfolio. We want it to be a material position, but we don't want the portfolio to become a directional view on gold because we can't predict the price of gold. Gold is the inverse of confidence in the human-made system. If we knew what was going to happen to confidence, we'd either own all gold or all equities. So therefore, we are pretty steady in our holdings of gold. And as the price went down, its position shrunk in the portfolio. And instead of rebuilding the gold bullion itself, physically, we bought the gold miners.
I see. All right. Matt McLennan, it's always a pleasure to have you and to have your point of view, which is usually fairly unique on WealthTrack from First Eagle Funds. We really appreciate your being here.
Well, thank you for having us on.
At the close of every WealthTrack, we try to give you one suggestion to help you build and protect your wealth over the long term. One way to do that is to adopt Matt McLennan's primary investment goal, which is to avoid the permanent impairment of capital. So in layman's terms, our action point is avoid investment losses. Most investors' top priority is to make money. However, the vast majority of great investors we talk to are more focused on the other end, not losing money, and in doing so, they make it. Their rules are simple: buy quality companies selling at deep discounts, invest with managers who care about shareholders, and in Matt's case, keep some insurance in your portfolio in the form of cash and gold to protect you when trouble hits. Well, next week, we're going to sit down for a television exclusive with a great investor who specializes in aggressive growth stocks. He is Clearbridge Investments' Richie Freeman. Please go to our website to see past WealthTrack interviews, exclusive insights into our guests, and research from our sources on WealthTrack Extra. And feel free to connect with us on Facebook and Twitter for WealthTrack updates, what we're reading, and more. In the meantime, have a great weekend and make the week ahead a profitable and a productive one.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Luma Sales, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. And Rosalind P. Walter.